Hey everybody, this is Brant from Wolf on Wall Street Trade with a market update for the week ending February 21st, 2020. There's a lot we could go over this week. S&P sectors alone could take up this whole video, but I would be remiss really for not getting to the heart of the issue, which is the macro environment and the signals that are being sent by the bond market, the currency market, the commodity market. When we get to gold or when we get to TLT, you'll probably see what I'm talking about. And what they're all screaming, not warning, but screaming, is that this coronavirus is a big deal. It's not contained, and they're screaming that there's a lot more to go on the downside. And the problem is stocks discounted about 3% over here and then went on to rally to new highs. They're really disconnected from economic reality and from the macro picture that's been developing. So here's a daily chart for the S&P 500. S&P lost 1.25% on the week. The Dow lost 1.4%. So you can see it came into this week a little bit weaker. Small caps, this is surprising. They only lost 0.5% this week. They were the best performer. We'll get into that when we get into the S&P sectors. And the worst performing of the major averages, which has been the best performing all year, was the NASDAQ 100. Now, it lost 1.85%. 10 of 11 S&P sectors were down. The only one that was up was the defensive real estate. Consumer staples and utilities weren't down that much. The worst performing sector out there was the best performing sector of 2020 that's led the market higher just about every single day, and that's technology. Here's technology. So this is a downside target for this leg down on Friday. It hit it and bounced from there. But this is a really ugly break because this trend line goes all the way back to the start of December. It broke it on this first Wuhan virus scare, rallied to a new high, and broke it again this week. Now, what I've been telling my members, and I've probably said it on these videos too, is that technology will be the last sector to go. What's interesting about this week is that it was the worst performing sector, and also consumer discretionary and communications, which are also filled with these mega cap FANG stocks like Facebook, Google, and Amazon, Microsoft. This is a post from February 14th. You can pause it if you want to read it, or I'll put a link in the video description. But it was basically a post to my members telling them what to look out for because we were starting to see negative divergences in IWM, SPY, QQQ not so much, but IWM here you can see. And what to watch out for with bond yields, what to watch out for with gold, that the situation was improving in gold, and then what to watch out for with currencies. And what's interesting was the chart of yields. The triangle is coming to an apex, which suggests a move sooner than later. At this rate, it comes to an apex next Thursday or Friday. Here's the technology sector. This is Thursday. This is Friday. So the gist of the week was selling in the mega cap stocks, and the sectors that hold them got hit the hardest. That would be technology, communications, and consumer discretionary. A lot of other sectors held up pretty well. That's why small caps held up pretty well. So I'm going to breeze through some of these sectors. So here's materials. It's not a heavily weighted sector, but it's growth sensitive. So it's interesting that it held up this week. Just to give you some perspective, this is the first leg decline consolidation. This is the Wuhan virus scare, and second leg decline more than hit the target over here. And then this is the bounce back over the last couple of weeks. So it did hold this support trend line. Here's energy. This is a sector that just got roasted with crude oil back here. So this is nothing more than a technical bounce. It hasn't done anything to improve the situation. It's kind of a bearish consolidation over here. But on the week, it lost about 0.8%. It's kind of below this trend line, but really didn't sell off too bad. It hasn't broken below this 53.50. Let me just give you a different perspective of this on a weekly chart. This is the last 3 weeks of bounce. So let me take off trend lines. We don't even need it. You can see this is a bearish consolidation. So 3 weeks, the sector has bounced, but it has not improved the technical outlook at all. Here's the financial sector. So here is its first leg decline. Consolidated, didn't make a second leg decline. This is when China intervened. So point here is that it has a supportive trend here that it kind of broke under. It has another support area right here about 30.50. If this sector had gone and broke down here, S&P, IWM would have been much worse. This is the industrial sector. Again, here's that Wuhan decline or decline into that Wuhan. Here's the bounce back the last 3 weeks. So it did break the trend, but it's got pretty good support over here at 83. And then again here, 82.25. So it could have been a lot worse. It did get a little bit ugly into the week with the Dow. Here's consumer staples, defensive sector. It's a bond proxy. I have no problem with the sector. These are my 3 favorite sectors: consumer staples, utilities, and real estate. They've been acting well Lots of support, big supportive trend here going all the way back through 2019. Support over here, support over here. I have no problem with this sector. Utilities, same thing, second best performing sector of the year. I'm not sure about after this week. It may be the best. Anyway, lots of support. It's acting well. Here's the real estate sector, also acting very well. Let me just go to a daily chart. You can see this breakout. I mean, they're acting beautifully, these defensive sectors. You may remember healthcare broke this big, important trend at the end of January. So this is one leg down, consolidation, second leg down. It's one of the few sectors that did hit this downside target where I'd expect it to bounce or consolidate. So this is the last 2 weeks rebound in stocks. Markets basically said, we don't think this virus is a big deal. And this week it did break this trend, but it's not the worst looking break, but it's something you're going to want to watch because of the weight of this sector. Second most heavily weighted behind technology. Here's consumer discretionary. It is known for its biggest component, which is Amazon. Here's the trend, and here is the break at the end of January. Got one leg down, didn't get that second leg down because China intervened in the market here, pumped hundreds of billions of dollars into it. This is the break of the trend this week. It's not horrible, but it is a break of trend. And here's a closer look. It did hit our downside target. So here was the first move on Thursday. Here is the break. There is the downside target. So it hit that on Friday and stayed right there. Pretty much what we expected. Doesn't mean it's better. It just means that that's where we'd expect it to consolidate or at least catch some local support. And then here's communications. A lot of trend lines here. This sector's been all over the place. But Facebook, for example, is a big component in this. So here's the break this week. First leg down, second leg down. Not a great looking chart at the end of the week, the way it ended the week. And this is interesting. This is transports, Dow Transports. So you can see the supportive trend line held that. Actually one of the better performing groups on the week, up 0.4%. You know, this is an example of why small caps held up better, why the S&P wasn't uglier than it could have been. A lot of these sectors, like I said, they held these support trend lines. So you want to keep an eye on these. Usually these sectors would be the first to go. What was interesting about this week was it was technology, the sector that I always expect to be the last to go. People wanted to get out of those mega cap stocks Thursday and Friday. So let's go to gold. This is GLD, and this is a 60-minute chart. This is one of those macro signals that was being sent very early this week. This is a consolidation. Gold has looked great. I wasn't crazy about the way it was acting right here. Then towards the end of this week, as you saw in that post I showed earlier, it improved a lot. So this is what it did Tuesday as the market opened. Remember, we were closed on Monday. It broke out. So gold broke out despite the US dollar rip-roaring strong. This alone was a major macro signal. Now the market, the stock market, rallied on Tuesday and Wednesday, acted like, you know, didn't have a care in the world. Gold was sending a different message. And let's see what it did the rest of the week. Boom, big strong breakout. And look at this daily chart. I mean, this is a beautiful, beautiful price chart. Very, very bullish. CNBC just tonight is saying, oh, now we love gold. After all this, now you love gold? Seriously? Gold has doubled the S&P's return year to date. 5-month, very bullish consolidation. This is a first leg. This is a consolidation between. This is the start of the second leg. I see gold hitting 1,700 on this move. That doesn't mean that's as far as gold can go. That's just where I see it heading on this move, and then I expect it to stop, consolidate, maybe something like this. This is the 30-year yield. This is peak recession fears in August of 2019. This is the phase 1 trade deal optimism bounce rally. This is nothing more than a correction. What's interesting is that it started to roll over into the beginning of the year and then accelerated on the first Wuhan virus scare. This consolidation here, this triangle that I was talking about in the post last week, it took place while the market bounced back from that first Wuhan virus scare, leg 1, leg 2. So notice the S&P made a new high, NASDAQ did too, the Dow. Small caps, by the way, did not. Yields did nothing but consolidate in this symmetrical triangle. The symmetrical triangle has no bias, bearish or bullish on its own. It depends on the preceding trend, which is down, which gives it a bearish bias. This is why I was expecting it to break down. That's what it did this week at the start of the week, Tuesday right here. This is a record low and a record low close for the 30-year yield. The stock market is just off record highs. Major disconnect. Let me touch on currencies real quick. This is the dollar yen. This fooled some traders early in the week, this huge, huge move, because this looks like a risk-on move. And this is why I always say there are general guidelines, but you can't assume that every relationship is constant. So a lot of traders saw this. They thought it was risk on. You have to understand what's going on around you. Japan, just the night before over here, had reported their Q4 GDP, and it dropped by 6.3% annualized. That means, this was Q4, keep in mind. This is before any effect of the coronavirus. That means Japan is heading for a technical recession. This was the yen being dumped because Japan is heading for a technical recession. This was not a risk-on move. As you can see, what happened the rest of the week in stocks. There are general relationships, rules of thumb, but you have to be aware of what's going on around you. This is AUD, USD, the Australian dollar versus the US dollar. Notice this trend. It's exactly the same as yields. This bounce through like Q3, Q4, 2019. Trade deal optimism. This over here is peak recession fears. Trade deal optimism breaks, turns down into January, into the start of the year, just like yields. Here's the 30-year yield again. Same trend, same breakdown. They're sending the same message. So this is Wuhan virus scare 1. This is the consolidation of the last 2 weeks as stocks had bounced. This is why I was saying in that post on the 14th, watch what this currency does. This is it breaking down to a low that it has not seen since 2009, coming out of the financial crisis. This is a commodity currency. It is sending a risk-off signal, a risk-off message, like we saw in copper and like we saw in crude oil. And pointing out one other thing real quick, this is the 30-year yield, again, daily chart. This is peak recession fears over here, August, September. This is the trade deal, phase 1 trade deal optimism that it is going to basically set everything right with the world economy. And then this is the turn down saying, well, maybe not so fast into January. This is really interesting. This week we got PMI data, manufacturing and services. Actually, I think that's one of the free posts, so you can check that out. I covered what happened with the PMI data. This is the composite of both services and manufacturing. Notice this same bounce in the economic data. Not all of it, but some of it. And what's basically been happening is that manufacturing has been leading lower, has been contractionary, below 50, or recessionary, and services has held up. And the market has said, well, U.S. is mostly a services economy, so we don't care about manufacturing being recessionary. Well, manufacturing tends to lead services. So the point is, we got this composite PMI, services and manufacturing both missed. Composite PMI under 50, this major plunge. Okay, that's a recessionary print. And what forecast this? What foreshadowed it? Yields did. Copper did. Crude did. Currency markets, bond markets are much bigger, much more sophisticated than stock markets. They have accurately seen what's coming and forecast it in advance. Stock markets are still off in la-la land, and that's because of the central banks pumping all this liquidity into the financial system. Here is the dollar-yuan pair, and this is a 60-minute chart. What's the level I've been talking about for, I don't know, 6 months, a year? $7, line in the sand, $7. So this obviously is a very China-centric currency. This pair broke out. That means the yuan went under 7, collapsed under 7. This is a risk-off signal. This is all about that coronavirus. So you might be thinking, well, okay, $7, okay, it's a risk-off level. I don't know what that means. This is the S&P futures here in candlesticks, and this is the dollar-yuan inverted, so it's basically looking at it from the yuan's perspective. This is the trade deal, phase 1 trade deal optimism trend. So this is coronavirus, the first time the market corrected on that. We've seen the market rally back. What have we seen the yuan do? Nothing, just like yields. Nothing, just consolidate. Then this week, break lower. This is one of those assets that's kind of screaming that the coronavirus is not contained. It is a bigger issue. Apple just admitted that this week. 30-year yield at all-time record lows. What does that mean? How can we put that in some perspective? Okay, so this is August back here, 60-minute chart of the S&P 500, 30-year yield. This is peak recession fears back here when the market was most worried about recession. Here is the start of the phase 1 trade deal. This is also where the Fed started injecting liquidity, started QE4, and started doing repo. One of the things that we saw before we saw this correction was that yields started leading lower into this high. Then stocks rallied. This is where bonds did nothing but consolidate in a small triangle. Sorry, that's not the best triangle, but you can see what's happened next. So the takeaway from this is that the 30-year yield is even lower than it was back in August at peak recession fears, while the stock market is way up here. This is just a proxy for the Australian dollar. What is it saying? The exact same thing. Okay, diverged negatively into this high, led the market lower. consolidated over here while the stock market rallied up to a new high, and it is now at a new low, new 11-year low. I'm not going to go through every single asset class, but I'm just making the point, that we have a bounce in crude, we have a bounce in copper. This is nothing. It's a bearish bounce, that's all. All these assets are saying the same thing. The breakout in gold, the move in TLT, which also broke out this week, following in gold's footsteps. Here's TLT on a 60-minute chart breaking out. Here's gold breaking out of its consolidation. Here's TLT following in its footsteps. They're all sending the same signal, the same message. Stocks have been going higher, just ignoring that message because the central banks have been pumping all this liquidity into the system. But what you should also note is that they're starting to taper it. And one of the interesting things this week, right before tech sold off, was the FOMC minutes over here on Wednesday afternoon. And what they said was that they are going to continue to taper repo, which they knocked down by another $5 billion this week, and that conditions are right now for them to start to taper QE as well by Q2. So as soon as that came out, we saw a change in character intraday on Wednesday, and then Thursday and Friday, the stocks that have basically been the recipient of all those funds, which are the FANGs or the MAGA stocks, got sold off. So as we head into next week, this is what I can tell you right now from the 3C charts. This is that divergence on Thursday, the 13th, and then I had that post out the 14th. So small caps didn't get a whole lot worse. They started to deteriorate over here. We saw an attempt to rotate from the mega caps to the small caps on Wednesday, the 19th over here. 3C did not confirm, and it came down a little bit more. But this is not as bad as some of the other places, like, for example, QQQ. So remember, it was really IWM that saw a negative divergence first on the 13th over here. SPY, QQQ started to follow. It wasn't that bad until we got into this week when they tried to rally it. No confirmation at all, and we see prices catching down to where 3C is. So no improvement on the week because you can see 3C is down, making new lower lows. And even before IWM started seeing negative signals on 3C, we saw VXX volatility seeing positive signals over here when prices were kind of flat into the 12th, the 13th, 14th, and it has since moved up. 3C's moved up and confirmed with it. So this chart is looking pretty strong too, which suggests that the volatility is not done. We probably have some more downside to go. From a big picture perspective or a macro picture perspective, well, you saw what I just showed you. So take what you want, leave the rest. So I think a test of this 50-day moving average is probably pretty likely in the next couple of weeks. All those other asset classes, they are screaming down much, much lower and saying this is a much bigger deal than stocks are currently pricing in. So that will do it for this video. If you liked it, please give it a thumbs up. And if you have questions or comments, go ahead and leave those in the comment section below. You can follow me on Twitter. And if you want to get updates on these videos, just subscribe down here, or I think there's a link even below. Everybody have a fantastic weekend. And members, I will see everybody on Monday.